Today's trading session was heavily influenced by ongoing geopolitical tensions and new economic data. Let's look at the major factors. The main drivers included the unresolved U.S.-Israel-led conflict against Iran, strategic oil reserve news, U.S. inflation data, and currency movements. The geopolitical uncertainty surrounding the U.S.-Israel conflict with Iran continues to keep markets on edge, leading to significant volatility in intraday price action. Market sentiment remains highly sensitive, reacting quickly to any new headlines related to the ongoing conflict. A major concern for investors is the lack of clear resolution regarding the U.S.-Israel-led conflict against Iran, sustaining the overall risk aversion. Intraday price action reflects this uncertainty, remaining highly volatile and sensitive to the tone of any breaking news or political statements. Switching focus to energy, there were developments regarding the global oil supply that impacted crude prices. The IEA confirmed its largest ever release of 400 million barrels of oil from the strategic reserve, a move generally seen as a positive for energy supply. However, the details reveal that the release will be over a time frame appropriate to each member country's national circumstances, suggesting the pace of oil hitting the market is unlikely to be urgent. In the United States, attention was on key economic data, specifically inflation, and its effect on Federal Reserve policy expectations. The U.S. February Consumer Price Index was spot on expectations, providing little immediate surprise to the market. Despite the expected CPI print, upside inflation risks from the ongoing conflict continue to loom large over the market outlook. In response, markets pushed back the next expected FOMC rate cut from September to December, causing Treasury yields to shoot significantly higher. Finally, let's examine the foreign exchange market and how major currencies performed against the U.S. dollar today. Against the backdrop of rising U.S. Treasury yields, most global currencies experienced weakening against the U.S. dollar. However, the Aussie dollar stood out, lifting to its highest level in 3 years, supported by favorable policy and yield differentials relative to the U.S. To summarize, March 12th was a day dominated by geopolitical risk and a shift in rate cut expectations,